Oh, thank you for having me, George. I'm excited to talk about the book and the progress of the U.S. over the past 230 years, and also some of the international implications as well we'll talk about. So I'm excited to be here. Thank you.
Absolutely. I'm in London and French Greek origin, so I'll have a European perspective on this
Yes.
financial history. But let's start from the beginning with Hamilton.
For this to succeed, that is someone else we need. I know. So he knows what to do in a trench, ingenuity, fluent in French. I mean, so you're gonna have to use him eventually. What's he gonna do?
Now, a hit in the London state. It's the start of the book and the start of the history. Can you tell us a bit about his role and the impact he has had on laying the foundation?
Yeah. So Hamilton, he's amazing in so many ways, and throughout the book, you'll see quotes 100, even 200 years later that are remarkably applicable over time. And what was really amazing about him, so if you go back to 1790, the United States was a financial mess. I mean, there was a lot of debt issued by the colonies to fund the war. It was trading at as low as 10 cents on the dollar because they couldn't pay it back. And Hamilton realized that establishing sound credit for the United States was critical for its survival and for its future growth. And in 1790 and 1791, he established really a three-pronged program to repair the finances of the United States. First of all, he consolidated all of the state debt and federal debt into a single debt issued by the federal government, a single series of bonds issued by the federal government. He also raised tariffs to ensure that the United States could pay back the debt and incurred during the Revolutionary War. And then he actually established the nation's first central bank, called the First Bank of the United States. And this repaired the debt of the United States. It put the nation on sound financial footing and really set the stage for what ultimately proved to be more than 230 years of, yes, it was stop and start. There are definitely challenges, but overall 230 years of progress and economic prosperity.
And that story of Hamilton, and in particular the central bank, I think is particularly telling in terms of the ebbs and flows and the ups and downs. And
Yeah.
I've learned in the book something that I found ludicrous and with 230 years insight, a bit funny, but it's really tragic that he died in a duel with the vice president, which, if you translate this into current times, it sounds so ludicrous. But the impact of the death of Hamilton has been also dramatic in terms of this progress, the short life of the first central bank and stuff like that, right? So this story is also about people, individuals.
And the funny thing is, it's hard to know exactly what caused the duel with Burr. Aaron Burr was the vice president that shot and killed Hamilton. And supposedly there was a slur from Hamilton that kind of prompted the duel. But what really supposedly prompted the animosity between the two was financial. So Aaron Burr had essentially created a water company surreptitiously to use as a bank, and got Hamilton's support, and that really aggravated Alexander Hamilton, led to his rivalry. He was constantly trying to obstruct Aaron Burr's political ambitions, and it kind of got worse and worse over time, and ended in a duel. So it was interesting that there's actually a financial aspect to that duel as well.
Yeah, and I don't know, this premature death of Hamilton surely has impacted the next few pages of the financial history. The first central bank didn't last that long, and there's been a few attempts until we managed to achieve to reach this level of the Fed we know now.
And this was an important part of the book, because my belief is that cryptocurrency is largely a reaction to skepticism of the need for a central bank. And people forget, we've had a central bank now in the United States and and also in Europe, but we've had a central bank since 1913. And this is a trend that you see in history a lot, when important institutions and laws have been around for a while, people forget that they're necessary. It's kind of like going outside walking outside in a rainstorm. You have an umbrella and be like, well, why do I need this umbrella? I'm not getting wet. You take it down, you get wet. And there's a lot of that happens. And this is an important theme in the book, showing we had the first Bank of the United States. It disappeared. I think it was 1811. It came back after pretty disastrous without it in 1816. That was the second Bank of the United States. Andrew Jackson killed the bank in the 1830s. A lot of messes occurred in the interim. And it's very important to see what happens, why certain institutions were formed, what happens when they disappear, because it seems like people are very skeptical of central banking again, and they don't understand that without a central bank, things can get pretty messy. They're there for a reason.
Yeah, that's the central bank. I mean, it's such an important aspect, but there's so much more that goes into a fully functioning financial system and stock market. As we're looking now, that was my introduction about marveling at the U.S. stock market. But I feel like reading the book, I feel like it's not just about the American dynamism today. It's about those foundations built over centuries. Can you guide us through, some of the steps that made it happen, that made the stock market what it is today? And I think regulation is a critical aspect.
Regulation is interesting, and you can't regulate everything. You kind of have to balance the need for regulation to ensure the proper functioning of markets, but without over-regulating where you're impeding the flow of capital. And that's a tough balance. It's always a challenge for both regulators and private industry. One interesting thing, it's actually just come up recently, that there's this strange sympathy and encouragement for people like Keith Gill and this meme stock phenomenon. And what's strange is whether it's he broke the law or not, I don't know, but he certainly broke the spirit of the law in terms of market manipulation. And people, it's almost like they're cheering people like him on because they stressed out a few hedge funds. But at the end of the day, market manipulation was outlawed for a very good reason in 1934. And what Wall Street was like before the 1934 Securities Exchange Act is you would see those types of, they're called stock pools back then, where people would pool their resources, either drive up the price of a stock to support their position or drive it down. And it was a disaster for individual investors. So what's strange to me is that the sympathy for what people like Keith Gill are doing, again, I don't know if he technically broke the law, but he certainly broke the spirit of the law by posting his positions, knowing that it's, that's going to cause a rise in the stock price. And people have lost sight that this is not good for markets, and it's individual investors are the victims. Those laws were designed not to help hedge funds, and trust me, I'm no fan of hedge funds, but that's not what those laws were designed to do. They were designed to protect individual investors. So, long story short, regulation is very important. There's actually quite a bit of evidence that after the Securities Act of 1933 and Securities Exchange Act of 1934, it actually helped Wall Street because people were less fearful of investing, and it actually attracted a lot of capital. So strangely there's a lot of natural opposition in the private sector to regulation, and some of it's warranted. Believe me, regulation can go too far, but regulation done in a targeted, skillful way is actually helpful to everybody.
Yeah, and it's such a hard job because you'll always be yelled at least in the moment. Maybe not so much with the benefits of hindsight and history, but you're in the crossfire whatever decision you make, really. Going back to that as well, still looking at the U.S. stock market from a European perspective, how much you should invest in the U.S. Do you think there's something, like I said, foundational?
I would go a little deeper than the stock market. If there's one thread that runs through U.S. financial history and economic history, it's the United States is a risk-taking culture that is forgiving, that holds people accountable for failure. And market forces take out companies all the time, but we have a culture where failure is not a stigma. And I think that underlying the stock market, we have a country that is, I haven't done a detailed comparison throughout the world, but my gut is we have a deeper acceptance of market forces, and that enables us to fail and progress at a quicker rate than a lot of countries throughout the world. And that's been consistent from 1790, and I think it's still there today.
One of the very fundamental shifts in investing has been this rise of passive investing, index fund. And one of my previous guests was Eric BALCHUNAS, who wrote The Bogle Effect.
Vanguard has an asset-weighted fee of 9 basis points. I think it's 8 this year. It keeps coming down.
So it's about simplicity, transparency, and cheaper fees. One of the trends that I noticed today is this reintroduction of complexity and the attractiveness of private assets, private equity in particular, introduced to the masses, which has been helped by new regulation and is heavily pushed in particular by Blackstone, and they see 80 trillion opportunity in private wealth. So how do we see this in a historical perspective?
This is a generalization, but I think it does apply to what's going on with private assets, is when Wall Street starts moving down market, it's usually not for the people that they're targeting's benefit. It's usually more in line with their benefit. And the challenge, I think the democratization, I think it's the wrong word, private assets is terrible. More so than publicly traded assets, you can get yourself in a lot of trouble in private assets, and they're much more expensive. And there's a cycle to it. So and this goes back to the 1800s and whaling, which I mentioned in the book. The cycle of private assets is a gap appears in the capital markets. In the case of private credit, which is the latest craze, which is toward the end of its cycle, after the global financial crisis, banks pulled back and there was a gap in lending. So the capital providers can demand a pretty substantial premium and get very good returns in the early days. Then everybody else sees those returns, starts flooding in, the returns get compressed, fees can get higher for the highest performers, and the opportunity evaporates. And there's this kind of general rule of thumb that when you're in private assets, you need to be top quartile. And the reason is, by the time they become real popular, they're so flooded with people who are not skilled enough that most of the investments are just not worth it. And we've seen this cycle play out with buyouts, that they had their heyday in the 80s for a variety of reasons, which I talk about in the book, hedge funds in the 1990s, and now private credit in the 2020s. And again, by the time private funds are moving down market to individuals, the cycle is toward the end. And that's why I think it's a big mistake. I think it's a disservice to investors.
What I wanted to try as well, as it's a book about history, is to look back at the history of this own podcast, quotes from previous guests, and make you reflect on that. One of them is from Athanasios PSAROFAGIS, an ETF analyst at Bloomberg.
There's probably never honestly been a better time to be an investor. You could build a global ETF portfolio, with some stocks, international bonds, commodities, for like less than 3 basis points in the U.S.
Well, I mean, whenever someone says never, I'm always skeptical, because if there's one thing I've learned by studying 230 plus years of U.S. financial history, it is very rare to see something that is unprecedented. So I don't think the time we live in now is, I actually think it depends on what dimension you're looking at, but I actually think it's a kind of a challenging time right now, because investors are bombarded with so much information, and it doesn't need to be this complex. So in that sense, I actually don't think it's a good time to be an investor. I think it's a very tricky time to be an investor. But on the flip side, if you're looking at fees, and if you accept that portfolios don't need to be that complex, yeah, it is a great time to be an investor, because you can get broad index funds for next to nothing, and the odds are in your favor at that point. So it really depends on what dimension you look at. In general, I don't think there's a lot of, in the financial media, there's a lot of, this is the best time to be an investor. We've never seen opportunities like this. And depending on what segment they're talking about, they're promoting this is the best time to get into it, and I'm just very skeptical when I hear that kind of thing.
Okay, perhaps you'll agree more with a quote from another historian that I interviewed, Edward Chancellor. He's a big advocate of historicism in financial markets.
A quant can calculate the movements of the heavenly planets like Newton, but you need other disciplines, including the discipline of a historian, to understand the madness of men.
I definitely agree.
All right. Another interesting thing, and it touches upon education, and that's something that I discussed with Bill Kelly from the CAIA. One of the things we discussed with him is education has to come first.
But it's got to be done wrapped in education, transparency, and that's what we live for every single day.
And that's something I think a bit tricky. We talked about regulation, we talked about innovation. Where do you see education in that space?
I think it's critical. And, there's a lot of financial literacy movements going on in the States. Various states are passing laws where it needs to be incorporated into the curriculum in high school. I think that's a very important trend and valuable trend that's happening in the United States, where I actually think education is neglected on all levels, though. I work mostly with trustees of pension plans and endowments and foundations, and that actually is one of the most critical and neglected tasks of advisors. And the reason it's actually almost more important for institutions because they're unstable. Their governance is unstable. They're constantly rotating trustees. They have very limited time, and really providing high level education on what they can and can't do, what advisors can and can't do, whether complexity and increased fees is actually adding value, is something that is more neglected than anything I've ever seen. And that's something that, I always appreciated as an investment consultant, but it was validated and appreciated more that that's really what advisors need to be focusing their efforts on, not adding all this complexity to their portfolios, adding fees that are not adding value. So education it's critical from, the lowest levels where people are just learning in elementary school and in high school, and at the highest levels for trustees that are overseeing trillions of assets for not only in the United States, but throughout the world.
And how do you see this happening? How does the role of the consultant or advisor plays into this education of trustees? Does it have to be active education?
So, well, the story, it's actually a pretty interesting story of how institutional investing has developed in the United States. It really started in the 1950s after the United States was just awash in wealth. But long story short, I talk about this in a chapter called Manufacturing Portfolio Complexity, and it tracks the really 80-year history of endowments, foundations, and pension plans in the United States. And this is going to compress it a little, but what really happened is you had performance reporting companies that were revealing that bank asset management departments were not serving institutions well. They moved them out, moved them into individual funds, added alternative investments, but they were really performance reporting companies that weren't really, this is generalization, but we're not really skilled investors. And that kept progressing. Now you're to the point where it's really odd because investment consulting firms and a lot of just kind of independent OCIOs are now managing institutions on a discretionary basis and reporting their performance, which is exactly the problem that was happening in the 1950s with the bank asset management department. So it's basically an industry that has come full circle. And it's gotten to be a real problem. If you look at a lot of these public pension plans, for instance, they're littered with active managers, alternative investments. And if you benchmark them versus a fully passive portfolio, most of them are underperforming. It's a real problem.
As I'm in this series of quoting a previous guest, I'll also quote Ludovic Philippe, who's a professor of private equity, and he recently posted that one of the reasons why people put so much private equity into endowments, and he was talking about Harvard, is that eventually that's a way to make money and make it interesting.
So, when you think about it, there's a very strong natural incentive for consultants, for OCIOs, for staff of some of these funds to add complexity to the plan, regardless of whether it expected to add value because it creates more demand for their services. And when you think about it, that's at the very heart of their being. That's a conflict of interest that needs to be managed. And I don't think most people are managing that very well.
So that brings me to the question of the introduction of the book. Let me read it. You said that as I simplified portfolios, I had a nagging fear that clients would fire me because eventually they would conclude that I was no longer needed to manage all the complexity. Nevertheless, as a fiduciary, I was obligated to recommend what's in their best interest and mine. But over the next 5 years, I was thrilled and relieved by the results. And maybe you can tell us about the rest, but it says you reduced fees, improve performance, and free up time to focus on more added value financial and investment activities.
Yeah. So my fear. So I was thinking about one client, one institution that their pension plan. I never viewed it as an option, right? There's no evidence at the company I was at that what we were doing worked in aggregate. And finally, I said, "Well, look, if there's no evidence that this is working, I have a fiduciary responsibility to do what's in the best interest of clients." So I started moving people to index funds, and there was this fear that, well, there's this pension plan in particular where we moved them almost entirely to index funds, and I'm thinking to myself, well, now they're going to fire me because there's nothing to do. But the opposite happened. So they had different pools of capital that were not being managed well throughout the company, and I ended up advising on that. I ended up doing some cash flow analysis to figure out what type of risk they could take at an overall level. And I became more valuable. The relationship actually expanded. So I kind of morphed toward the end into more of a financial advisor for institutions. And I was able to do that and focus on things that really mattered because I wasn't weighed down with the constant hiring and firing of active managers, looking at their asset allocation every year and tweaking a couple of asset classes. It really it enabled me to shed the non-value added tasks and add value added tasks and made me more valuable. And that was it was a relief, but it was a little scary when I first started moving in that direction. It was very scary when I started moving in that direction.
This is an interesting individual example. Do you see that as a potential trend towards where financial advice is heading?
Yes. I don't. It's not heading there fast enough, I don't believe. But that if there's one message that there's this fear of becoming obsolete. Financial advisors, staff, and to be honest with you, some of it's legitimate. If your only value added is constantly hiring and firing managers and you can't move beyond that, well yeah, I mean that you're not adding value and your career or your firm is at risk. But if you eliminate those tasks that are not adding value and you find gaps in the need for financial advice that are not being filled and you fill them, you actually are adding value and you're going to be rewarded for it. And that's it's kind of consistent with the history of the United States, right? Like things age out and innovators come in and fill unfulfilled needs. And I think this industry is long overdue for that.
That's so telling about what you said initially, about the culture of risk, of creative destruction, to keep it short, etc., in the United States. And that's where, again, if I compare it to Europe, it's definitely a big difference. And if I also link it back to, we talk about financial education, and that's also part of it. But ultimately, well, I don't know if we can call it the spirit, but there's something there, right?
Yeah, it's consistent with that. And I think it's long overdue in this industry. And I think it may help to reinforce that advisors who move first, particularly, are going to benefit by accepting reality, accepting their limits, and actually adding real value to their clients and being honest. There's a great quote that always inspires me. I never viewed this as an option, right? I mean, I had a fiduciary responsibility to recommend what I thought was in the best interest of my clients. And if moving to index funds was in their best interest, regardless of how it impacted me, I had an obligation to do that. And that's really fundamentally what drove me. There's this quote from, her name is Hetty Green. She's, as far as I'm concerned, she's the best investor in all of U.S. financial history. She lived during the Gilded Age and early 1900s. She had a quote that said, when you're honest these days, people accuse you of being mad. And sometimes I feel like that there's so much resistance to change that sometimes I feel like, people look at me as if I'm crazy, but I think it's pretty logical, and it's based on 230 years of history.
So you were a financial advisor before, and you're a financial advisor now. Of course, you were also involved in history before. But how has this book, changed your perspective, or maybe your conversations with clients?
Yeah, so I had an interesting experience about a year ago. I actually still keep in touch with her. I was just emailing her today. Her name's Mutheri Wahome. She wrote the financial history, the history of capital markets in South Africa. And we didn't realize we were kind of living parallel lives. She was writing her book while I was writing my book, and we met online and have been communicating a lot since. And she actually endorsed my book, and I endorsed hers. But the thing when we were talking, the thing that stuck out most in terms of how we changed was just our calm. That when I went through the history of the United States starting in 1790 and reading my way to the present, and after you've seen things repeat several times and you've seen how bad things have been, and they've been worse, much worse than they are right now, it's hard to get spooked anymore. And that it doesn't necessarily enable you to profit from envisioning the future, but it does enable you to have a calm and to help others have calm in the wake of what seems like unprecedented events when they're really not. And so there's a sense of calm and thinking on a different time horizon that comes from reading history. And I hope people can get that when they read the book. It was hard to compress all that into 523 pages, but I think at least some of that they can get from reading the book.
No, absolutely. I think there were two gaps, or from my very limited, reading of history books. First of all, many books that look at financial or economic history, it's more economic histories and policies, and the ups and downs, and not so much the foundations. And secondly, making it easy to draw parallels with what's happened today. And that's go back to my point about, historicism being a neglected skill in terms of financial markets in general.
Yeah, I mean, it seems like one advantage I had is I wasn't coming from academia. I've always been a writer, but it's entirely been business writing. And so that was helpful in terms of taking a fresh perspective, first of all, toward history, but also always having a practical lens that I was using to write. Cited a lot of sources, and I hope it meets an academic threshold, but I always wanted to make this practical so people could use it actually to make better decisions. And there are two things that was one of the gaps that I was hoping to fill with this book. The other gap is it's almost a gap in academia where academics tend to focus on specific periods, and they do a great job, by the way. I couldn't have written this book without reading 200 books that had been written on specific periods or specific issues. But it's rare to find kind of broad swaths that go through the entire history. And I kind of feel like that should be a new genre out there. I think you could do this with healthcare. I think you could do it with a lot of issues and track the full history so people can better explain it and it can have practical value. I just think that seems to me to be a gap in academia right now.
Yeah, absolutely. Your book manages to bring it all together. Maybe just another quote from a guest, which is from Dan DAVIES, was also, as I was asking him about how do we prevent fraud, etc.
The trouble with fraud, it's like the evil twin of the real economy. It's part of the real economy, and you can't necessarily get rid of it.
You have no idea how much fraud. You think it's bad now? The late 1800s was the Wild West of fraud.
Exactly, but eventually things have improved, and also those railways have been built, and this is what I find fascinating through all that, or almost surprising.
Yeah. So, this is my apology to Europe. So the
No,
way
go for it.
there was this financing cycle that went on in the 1800s, and it worked something like this. The United States was essentially the most attractive emerging market. And so it happened with canals, happened with railroads. We would get our capital from Europe and completely overbuild. There'd be a crash. The Europeans would sell out everything, and then the Americans would buy the few viable entities that remained for pennies on the dollar. So essentially, our infrastructure was funded by foreigners, and then we actually own the assets as well during the crash. And this cycle happened several times. But this is another thing you see when you go 230 years is the railroads. I talk about the Gilded Age. The section on the Gilded Age it's going to develop. It's going to give you a higher tolerance for cognitive dissonance, holding two just completely opposite thoughts at the same time. And there's the one paradox in the United States is you'll have a lot of grift, you'll have a lot of corruption, but then the things that get built end up creating a lot of good. And that was the story of the Gilded Age. The railroads, ton of corruption, labor abuse, all kinds of bad things. But if it weren't for the railroads, we would have had a trouble with the arsenal of democracy and arming the Allies to defeat the Nazis and the Empire of Japan. So there's a lot of that throughout U.S. history where there's a lot of bad and good at the same time. Now, I would argue very strongly that there's more good in the United States and that there still is more good in the United States. Doesn't move linearly, like you said, but I believe that this country has a spirit of innovation, a spirit of improvement, where the pendulum goes back and forth, but at the end of the day, it's moving forward.
And going back to where we were at the beginning, my initial question about the U.S. financial markets and all that, and its edge over the rest of the world is perhaps that. And I think what I'm trying to reflect is, okay, aside from valuations, right? Aside from the fact that it's at the all-time high, and I feel like in this history, you can find the foundations of, basically stronger foundations, build stronger trees or something like that.
I guess you could say that. And, with respect to valuations, though, if you're a long-term investor, it's very hard to do this kind of instinctually. But if you're a long-term investor and you're rebalancing your portfolio in a disciplined way, you shouldn't be concerned about valuations, because in the long term, your horizon is 20, 30 years out. It doesn't really matter. You're not going to be thinking about what you did 20 or 30 years ago. Now, you do need to rebalance your portfolio. That's very important. But it seems like a lot of long-term investors that have a 20, 30-year horizon are really thinking in terms of a couple months. If they're reacting to market movements, they're really not a long-term investor. They're thinking in terms of months, maybe a couple of years. And that's just too difficult to predict. And that's a common mistake where long-term investors really don't behave like long-term investors. They behave like short-term speculators.
Yeah, that's a good call. And in fact, taking the example of Japan, a long-term investor who would have rebalanced over years would have been in a good position to benefit from the new highs, which have been just recently.
If you're really a long-term investor, I don't, I look at headlines, but to see if anything meaningful has happened, which it usually is not. But you don't get concerned with what's happening in the market. That's why Warren Buffett's so calm. He's a real long-term investor. And it's a rarity. I will say understanding history really helps you in that respect. I joke with my wife all the time. I feel like I'm 230 years old now. And I joke about thinking like a 200-year-old, like what happens in the next couple of years just doesn't really matter that much.
I think that's such an important perspective on history. And I refer again to the conclusion of your book. I was starting this podcast saying about, how everything, let's say, things look pretty rosy. I remember the conclusion of your book saying the shadows. I think it's the shadows of the future where you were perhaps very much more balanced. But in fact, drawing on what you just said, it doesn't really matter. It's always about the long term and not the outlook.
Yeah, I mean, it does. I don't want to say it doesn't completely matter. I mean, some things do happen that are pretty significant. When the Silicon Valley Bank run happened, that was a significant event, and the Fed needed to step in. What history enables you to do, though, is there's a lot of noise. Once in a while, it's not noise, and it's easier to pick out those moments when you understand history. And I will say, understanding the inflation of 1919 and 1920, and the Fed's response, and the great inflation of 1965 to 1982 was very critical to understanding what this inflation was after COVID-19, how the Fed's likely going to respond and continue to respond. So it does enable you to see some basic shapes in the future. And that actually is really valuable in a predictive sense. But mostly it's for calming people down, explaining some scenarios that may happen, but not trying to tactically allocate their portfolio to take advantage of it.
It's also a reminder of what you said about we can't just say it's the best time now, even if it's cheaper than yesterday or things like that. That's also a good reflection on history. It actually helps in a behavioral sense, and behavioral is the challenge
absolutely
of investors, right? And there's another interesting book about the psychology of money, which I really liked, and eventually it's all behavioral.
It is, and history can help. History was very helpful. I've been writing about the Fed for the past, really 3.5 years, and understanding the history of those two events, which I mentioned, the post-Great Influenza, World War I inflation, and the Great Inflation of 1965 to 1982, was critical in being able to navigate that psychologically. If I was on Wall Street really focused on security analysis, that probably could help in terms of profiting, but that's not the mission that I've taken on.
Something that's very important to me is, the individual investor's perspective and the education, and on again an individual perspective. So I think you've made a very strong case in terms of investing your time in studying history, but it makes me think as well on how perhaps our financial education is too geared towards, let's say, the mechanism of financial markets today and security analysis and stuff like that. That's things that keep coming into every possible app that talks about, we're going to educate you about finance today.
I agree. I think one of the biggest misconceptions, I would say the biggest misconception in investing, is that people are used to hiring a specialist in an area that they're weak to compensate. So you hire a plumber when you have a leak. You hire a lawyer when you have a legal issue. You hire a doctor when you have a medical issue. And as long as they're smarter than you, there's value added. That's not how it works in securities markets. What you have in securities markets is a lot of smart people competing with each other. And because of the law of large numbers or the wisdom of crowds, whatever you want to call it, the average price that they come up with a security tends to reflect the actual value. And to find a mispriced security, you not only have to be better than the people investing with you, you have to be better than like 95, 90, maybe even 99% of all of the other analysts. It's extremely difficult. So it's not good enough to just hire somebody who's smarter than you. You have to hire somebody who's smarter than everybody else. And to be able to determine that, you have to be one of the people that's smarter than everybody else. So almost nobody can do it. And that's really the way it works. And that's the argument for indexing. And I think people don't understand generally that the rules are different than hiring a specialist that they're accustomed to doing.
So I'll place all my podcasts, unless you're Jim Simons, which we've discussed as well previously in this podcast.
He's a rarity, though. He's an anomaly.
He's rare, exactly.
Jim Simons is unique in a lot of different ways. Part of it is the track record and the consistency, which I've never seen before.
And it was capped, by the way. So the Medallion Fund was capped at $20 billion, and the vast majority of the money was their own money. So it's not even you couldn't even invest in it anyway. So it's kind of like a moot point.
Absolutely. So it's a total exception. We have a podcast with Greg Zuckerman where we discussed all this.
Greg, I know Greg, and he was kind enough to endorse my book too. That book he wrote is fantastic.
I like when we loop it out, but otherwise, I think you're better off investing your time in financial history and investing your time in investing in US financial history. Such a wonderful book. We're very grateful to have it because I think it's not just a book that personally I read and it's been nice, but it's something that I have as a reference. It's something that I will go back to, and tomorrow there's going to be something else. It's not going to be inflation. It's going to be another topic. And I feel
That's
very
right.
confident that I'll find something that relates to it and will help.
Well, thank you so much. And it's going to continue to be updated probably over 2 years. But, one of the beauties of it is that a lot of it doesn't change. There may be some things to highlight that I missed. And, obviously I'll add more material toward the end. But, a lot of what's in the book really doesn't change.